Hey, what's up, everybody? It's Monday, March 22nd. I just sent out the new edition of MMT Trader. If you want that, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial. All right, let's talk a little macroeconomics. Actually, kind of was thinking about this conversation today because of comments that I saw posted in response to my Turkish lira video yesterday. So, people saying, and not just from you guys, but I hear this online. I mean, I'm seeing this, I'm reading this online too. Like, Turkey has a big current account deficit, so it has to get money to finance that. All right, it has a current account deficit, or when you talk about a country with a trade deficit, it's got to finance that. Let's understand something. The very fact that a current account or a trade balance is in deficit is proof that it has already been financed. It's not like you got to go out and look for money to finance that. And to understand why that is, you have to understand a little bit about accounting. It's called a current account balance. It's called a trade balance, like a balance sheet. So I'll give you an example. Let's say I live in Turkey, and usually countries that have trade deficits or current account deficits, how does that happen? They import more than they export, right? Like the United States has both a current account deficit and a trade deficit. So let's say I live in Turkey, and let's say, I buy a Japanese car. Let's say I buy a Honda, right? So what happens is that I go to a Honda dealer in Turkey. I decide to buy the Honda, and my bank will credit the bank of the Japanese automaker. Honda has an account in Turkey at a bank, and my bank will credit for the price of the Honda, whatever. Let's say it's $35,000. We'll just use dollars. I get the car, and the Japanese car company, Honda, gets a credit in its account, in its bank in Turkey. Now, if it wants, it could take the money back to Japan, but usually it keeps it there because it's conducting business and commerce in the country. So the two sides balance. I get goods, and simultaneously, there's a credit in the account of Honda in a bank in Turkey. All right, and that is called financing the current account deficit. That is called financing the trade deficit. It's not like, a country runs a trade deficit and then they gotta go out somewhere and look for money to make that balance. This is double entry accounting. For every debit, there is a credit. All right. For every credit, there is a debit. For every asset, there's a liability, and vice versa. All right? So, when they say, the lira is in trouble because they're running a current account deficit, and, it's generally, I would agree, it is a negative factor to run current account deficits like the United States runs current account deficits all the time. But there's no, financing of it per se. It happens automatically at the transaction. Now, let's look at it the other way around. Why is a country like Japan that runs a current account surplus considered a creditor nation? Look at it from the other way around. All right? The Japanese car company sold the vehicle, right? So they're actually like a debit. That's a debit in goods, but it is a credit in finance, in capital. They're the ones who receive the payment, so that is considered that they are the creditor, even though actually the funds probably came from a Turkish bank or some international bank. Well, even if I lived in Turkey and I paid for it in cash with my own savings, it's still accounted for that the seller, Honda, is the creditor and I am the debtor in terms of the capital, but in terms of the goods, I'm the beneficiary of the goods. All right, I have a surplus in goods a debit in capital. They have a surplus in capital, a debit in goods. It's not like they got to go out and run out and look for the money. Now, let's get back again to the interest rate thing. I mean, I'm really fascinated by this, that people are still making this argument. If interest rates affected exchange rates to the degree that so many of you think, the Japanese yen would be the weakest currency in the world. I mean, they've had zero rate, negative rates now for years and years and years. And it's one of the strongest currencies, if not the strongest. Or the Swiss franc. There's another great example. Negative rates to the tune, I think, even greater than Japan. Swiss franc is one of the strongest, if not the strongest currency in the world. On the flip side of that, I mean, pick a country. Argentina, Ukraine, Turkey right now, recently, right? Jacking up interest rates. It destroys the currency. It raises the inflation level. Show me a country with high inflation and I want you to tell me that's going to have a really strong currency. Look at that inflation. You guys love to talk about like Zimbabwe, right? They were raising rates like crazy over there. But there were other problems in that country too that led to the hyperinflation. Like, you know, it was very corrupt. Their ability to, their economy was just in tatters. It's actually much better now. And rates have come down. I don't know what's so hard to understand. Like the thing is, like, so many of you have these baked in beliefs. And, you know, like, you don't want to let go of these beliefs. And if somebody tells you the opposite thing of these beliefs, even if it happens to be true, like, you will fight and argue against that. It doesn't matter how much evidence that I can provide to change your mind. That's true of people about religion. It's true for people about many, many things. If something runs counter to your beliefs, it's going to cause you stress. It's going to cause you cognitive dissonance. Like, you just, you know, it's not going to work for you. It's kind of like cult-like thinking, and you can't break from it. Now, some people, they welcome knowledge and information, right? And they go with it as far as they can. Like, they have a thirst for it. And they, you know, they're just like, they seek it out. They want more. Like, every new level of knowledge and understanding, it opens up a whole other entire realm for them. And then there's more questions to be answered. They want more. And they progress and they progress and they progress. And it's a never-ending thing. It's constant learning. Constant learning. Those people are rare. Because many people, they're just like stuck in their beliefs and that's it. And nothing's going to change. And, you know, there's nothing I can do beyond what I say here information-wise. And, you know, you can go check it out and look it up. But if you're stuck in that belief, you're going to stay in that belief. You cannot move out of that belief. It is paralyzing to you to even consider moving out of that belief. That throws your whole world topsy-turvy. So, I mean, I just say, hey, if that's you, have at it. I mean, just enjoy it. Go with it. Doesn't bother me. You know, I'm of the other sort that I talked about. I mean, I love knowledge. I used to, by the way, a long time ago, I used to think like a lot of you guys, like the United States was broke, we're running out of money, you know, we can't do this, we can't do that, we borrow from China, China's our banker, all this stuff. And that's just in the realm of economics. I'm sure there's a lot of other things that where, you know, you got a belief system that is so entrenched and so rigid and so closed, like you're just not open to new ideas. So that's what it means to finance a current account deficit or a trade deficit. It happens automatically. Remember, we live in a world of double entry accounting. For every debit, there's a credit. For every asset, there's a liability. And that's the way it works. All right? Nothing scary about it. Nobody's out there running around looking for money. The fact that the deficit exists already means it's been financed. And if a surplus existed, it already means that that country is a creditor, at least accounting-wise. A creditor in capital, a debtor in goods and services, right? It's got a balance. I mean, if I'm getting the money, somebody's getting the goods and services. It's a balance. All right, everyone. Enjoy. Bye-bye.